So, good afternoon. My name is Etienne Bassot. I'm the Director of the Members Research Service at the European Parliament Research Service. I'd like to welcome our panelists. I'd like to welcome our first Vice President, Otmar Karas, and of course, I'd like to welcome you watching us online for this event dedicated to the IMF International Monetary Fund Regional Economic Outlook. The topic this year is, as we could expect, navigating war, energy crisis, and interest rates. This war that Russia launched on the European continent against Ukraine has put a lot of our assumptions into questions. It has been a shock for our economies, and we see domino effects happening and affecting our economies and societies, and we need to answer this to build up resilience. This is going to be the topic of our discussions today. With our panelists, we have 1.5 hours. I'd just like to mention that it is the fourth time that we have this presentation of the IMF Regional Economic Outlook, and this is for me showing the very high quality of our partnership with the IMF, something that is a precious asset for the EPRS and the European Parliament. I'd like, without further ado, introduce our first Vice President, Mr. Otmar Karas. Mr. Karas has been member of the European Parliament since 1999. He is in the Bureau of the European Parliament, which is the college of the President and the Vice President, in charge, among many things, is in charge of research, and his other responsibilities include information and communication policy, includes relation with NATO, the OSCE, World Bank, and of course the IMF. He's member of the Parliament's Committee on Economic and Monetary Affairs and the Parliament's delegation for the relations with the United States. Prior to his election to European Parliament, Mr. Karas was a member of the Austrian Parliament and Secretary General of the Austrian People's Party, and is visiting lecturer at Danube University Krems, the Vienna University for Economics and Business, and the University of Vienna. Very honored to have you with us today, Mr. Karas, and over to you for the introduction. Thank you.
Yeah, dear Etienne, good afternoon. Ladies and gentlemen, dear panelists, dear members of the European Parliament, dear representatives of the EPRS and IMF. I am delighted to open yet another event organized by the European Parliamentary Research Service and the International Monetary Fund, our important partner. We have developed excellent relations between those two institutions. That is important because your forecasts, analyses, and global overviews are a crucial source for our work as European Parliament. They raise awareness, promote dialogue, and stimulate joint action. I am especially happy to welcome as speakers distinguished economists from think tanks and universities, and a co-author of the Regional Economic Outlook for Europe. Your report is one of the IMF's flagship publications, assessing recent economic developments and prospects, in our case for Europe. I wish we could have this discussion in better times. Russia's war against Ukraine causes unthinkable human suffering. Tens of thousands have been killed, innocent women, men and children. We should always keep in mind Ukrainians are fighting also for our freedom, for our values. This is the biggest military conflict since the Second World War in Europe, and it has deep economic and social consequences. The report we are about to discuss focuses on the challenges for the euro area and the wider European Union at a time when war undermines our economic recovery from the pandemic. And it paints quite a dark picture of the short-term prospects of the European economy. This winter, more than half of the Eurozone countries may experience recession. There may be at least 2 consecutive quarters of shrinking output. And while inflation is projected to decline next year, it will stay significantly above central bank objectives. European governments and monetary authorities face severe trade-offs and tough policy choices as they address a toxic mix of weak growth and high inflation that could worsen. I welcome all efforts to develop a European response to the energy crisis. We have made some progress, but a lot of work remains to be done in order to establish an integrated energy union, which reduces our dependency from fossil fuels and expands renewables. We must swiftly negotiate, adopt and implement the joint gas pushing, the increased flexibility for temporary state aid, the new solidarity mechanism in the event of supply bottlenecks, the new price corridor and European price index, the new instrument for trading interruption to prevent speculation, and the accelerated reform of the electricity market. Our sustainable future can only be built if we stimulate massive investment in green energy and alignment of all sources of finance is required: public, private, national and multilateral. At the same time, individual governments must avoid all measures that could distort our single market and weaken our common response. Hence, I agree with the IMF that we should step up reforms that enhance productivity, that relieve supply constraints in energy and labor markets, and that expand economic capacity. Because it remains essential to boost sustainable growth and to ease price pressures over the medium term. As the fund points out, boldness, cooperation and solidarity helped to pull Europe out of the pandemic crisis. Only if we act in the same spirit, the challenges ahead of us can be met. This conference is an excellent opportunity to discuss what needs to be done, not only to ease the pain caused by the war, but also to develop our union further. Let us hope for the best, but prepare for the worst. In this spirit, I wish you fruitful debate, and I wish you a very interesting afternoon with and in the European Parliament.
Thank you very much, first Vice President, for setting the scene so effectively and for presenting the economic challenges and putting them also in the context of the human tragedy that is happening at the east of the continent. I'm sure our speakers will come back to these realities in their contributions. I would like to hand over the baton to Lasse Böhm. Lasse is the head of our Economic Policies Unit, which is also responsible for energy in our settings. And Lasse, over to you to introduce our speakers and to moderate the discussion. Thank you.
Thank you, Etienne, and a warm welcome from my side. We are, of course, talking about this publication here. This is the Regional Economic Outlook presented recently by the International Monetary Fund, which you can also find online on the site of the IMF. And you find the link in the chat. We are very pleased to have the author of this document here with us today, Romain Duval, Assistant Director in the European Department of the IMF, with a long and distinguished history working for both the IMF as well as early on in his career in the OECD. And he's also published widely on the topics that we will be talking about, which are, of course, on everyone's mind: high interest rates, low growth, sky-high energy prices. So how do we navigate this very difficult environment? Before I give the floor to Romain, however, let me also introduce the other three panelists, three very distinguished guests. I'm very pleased to welcome Charles Wiplosch, Emeritus Professor of International Economics at the Graduate Institute in Geneva, and I think a well-known household name, if I may say, in econ circles in the European Parliament. He has already been to the European Parliament in the past, is a well-known contributor in the public media as well, and I think he will have some interesting things to say in reaction to the IMF forecast, in particular about how the EU might develop and some of the responses that the EU and member states need to find. We also have Valentina Meliciani, Professor of Applied Economics at the University Luis Guido Carli in Rome, who is also director of the School of European Political Economy. She has published widely on industrial economics, international economics, regional economics. So on the applied side of things, so we will not only look at the macroeconomic framework, as it were, but also on the effects of the current crisis on businesses and people in Europe. And I'm very pleased to have you here, Valentina. And finally, a warm welcome to Agathe Demaret, who joins us from London as Director of Global Forecasting at the Economist Intelligence Unit, EIU. She also recently wrote a book about sanctions. She spent a lot of time in Russia, so that makes a very interesting mixture. So we will branch out eventually our discussion into the policy responses, such as energy and of course sanctions, and I'm very pleased that Agathe, you could join us here this afternoon. But without further ado, I suggest I give the floor to Romain for his presentation, and then we have short interventions or reactions from the three other panelists, and then we will kick off our discussion. Romain, warm welcome to you. Floor is yours. Go ahead.
Thanks a lot, Lars. First of all, I would really most warmly, sincerely thank EPRS for putting together such a great event. I actually had the opportunity to present many years ago in another context, and I really see that there's been an incredible ramping up in terms of the depth, breadth, and ambition of the events over the years, and so that's very appreciated. Also want to thank first Vice President Caras and Etienne Basso, and also you, Lars, and Cecile for dealing with us, I would say, behind the scenes. So without further ado, I'm going to present you very briefly the latest IMF economic outlook for Europe. Let me start sharing maybe my slides. The first thing I want to say is that clearly before Russia's invasion, sorry, I'm trying to do two things at the same time, so let me first share. Before Russia's invasion of Ukraine, we were seeing a very strong recovery in Europe from the pandemic. We were at the IMF quite optimistic about Europe's near-term prospects because we were seeing a gradual handover from public demand, fiscal stimulus, to private demand for a more sustained recovery. We were seeing inflation pressures building up, but we were optimistic that without any further commodity price shock, these inflation pressures would ease, and we would see a couple of years of fairly sustained and stable growth. Russia's invasion of Ukraine changed this picture completely, and now what we're seeing is a dramatic weakening of the European outlook under confluence of adverse forces. The main one is the fact that Russian gas flows to Europe have dried up. You can see that on this left chart. We are now at about 15% of Russian gas flows vis-a-vis the levels that prevailed over the year 2021. That has led to a renewed bout of inflation in Europe that came on top of the COVID-related inflation. And as a result of this, and also I think as a result of higher and more persistent than expected inflation, inflation surprised on the upside because of energy, but also because of other factors I'll come back to. So because of this inflationary environment and surprises, we've seen a synchronized tightening of monetary policies around the world. And you see that in the middle chart where the blue bars show you the number of countries that changed their policy rates in a positive direction, so increase their policy rates. And as you can see, recently we've seen the biggest number of such changes in the last 15 years. So this synchronized monetary policy tightening has also been accompanied by a tightening of financial conditions, long-term interest rates increase, government bond spreads for emerging markets also rose. We saw banks starting tightening access to credit. We see that in regular surveys that are run by banks. And this tightening of financial condition is going to weigh on the housing, investment, and consumption outlook. Right? On top of that, we cannot really expect that much from a European perspective from external demand, because on the external side, what we've seen over the past year has been a regular downward revision of growth outside of Europe, and in particular in China and the US. Some of the reasons are common to those that are slowing Europe's economy, such as higher energy prices, inflation surprising on the upside, and tighter monetary policies, especially in the US. But there's also more idiosyncratic factors, such as in the case of China, the zero COVID policies and lockdowns, and also the property sector downturn. And the slowdown in China alone that we've seen in the past year, vis-a-vis our forecast, that would on its own reduce Europe's GDP growth by 0.3 percentage point this year. So, the China effect alone is quite large. Now, if we think of energy security, which is a very big concern and an important driver of our forecast, I think that it's fair to say that Europe's response to the energy crisis risk triggered by the invasion of Ukraine has been swift and decisive, very strong. And as a result of that, we've seen storage levels filling up quickly throughout this summer. You can see that on the left chart, and the left chart is even missing the last two observations. And what you would see if these were added would be that we are now very close to maximum capacity, maximum storage levels, also owing to a mild October and early November. Even so, that's the good news, but even so, prices have skyrocketed. Despite their recent decline on mild weather, they're still 4 times higher than they were pre-war. And we are in a knife edge situation in the sense that prices could very well increase sharply again this winter if there were to be a harsh winter, something I will come back to shortly. This energy price increases have contributed massively to the rise in inflation we've seen in Europe. You can see from this left chart for the euro area, but also from the right chart, which covers emerging economies, that food and energy have accounted for about 2/3 of inflation lately in Europe. A footnote here, emerging economies are going to refer as the European economies we classify at the IMF as emerging. So in practice, these aggregates are going to be dominated by Poland, Hungary, Romania, Bulgaria, plus the Western Balkans. And we're excluding here Russia and Ukraine for comparative purposes. So 2/3 of the inflation has been accounted for by energy and food. At the same time, we're seeing also broadening inflationary pressures. And you see that, for example, in the green bars on the left. We've got services inflation running now at 4.5% in Europe, and services inflation is not that much affected by commodity and commodity prices. This inflation has not yet translated into a sharp acceleration of wages in Europe, especially in the west of Europe. As a result of that, as you can see on the right, real wages, that is nominal wages deflated by consumer prices, real wages have fallen quite sharply, and they are now back to where they were in 2018. And that's all the more surprising as labor markets are quite tight in Europe. We can see that in different ways. In the middle chart, you see that hours worked in Europe are pretty much back to where they were prior to COVID. So it's a full recovery in hours worked that we've seen. And second, you can see on the left chart that the ratio of vacancies, job vacancies to unemployed workers is now way above where it was prior to COVID in the euro area. That's the red line, as you can see it here. And in emerging Europe, it's not above the pre-COVID level simply because already prior to COVID, the vacancy to unemployment ratio was very high. So we've got very tight labor markets in Europe. And what this situation means so far is that, so one, workers are losing purchasing power, and that's going to weigh on the consumption outlook. But two, given that we have tight labor markets and that wages have not caught up upon inflation, there's also inflation risk, wage inflation risk, and further price inflation risk down the pipe that I'd come back to also. But for now, with falling real wages, tightening financial conditions, the consumption outlook is weakening dramatically, and that's a major driver of this downgrade in our forecast that we've come up with just 2 weeks ago. The left chart here shows you that the rise in energy prices that we've seen in European economies on its own, right, has increased the cost of living for households on average by about 7%. But as you can see here, in some countries, the rise is much larger. For example, in a country like Estonia, the rise in the cost of living due to higher energy prices is in the order of 20%. So this is a massive shock. Until recently, this massive shock was partly offset by de-saving by households. Households had accumulated savings during COVID because of the lockdowns and the impossibility to consume certain types of goods and services. And you can see that in the middle chart. If you focus just on the blue bars, you see that saving in the euro area increased quite a lot in the first phase of COVID. But since then, these extra savings have been shrinking, and we are now back to the kind of savings we were seeing prior to COVID. So this, this impetus to consumption growth is basically waning. And indeed, you see in the right chart that from household surveys, we're seeing that households are now expecting to reduce their major purchases in the next 12 months. And that's a trend we've seen in the last few months. So clearly a deterioration of the consumption outlook, and the investment outlook is also going to be affected by this weaker consumption outlook, plus tighter financial conditions, plus weak external demand, as I've mentioned. Now, on the policy side, also the environment is becoming less conducive to growth. And that's true on the monetary policy front, where you can see on the right that in 2022 and 23, there will be an increase in policy rates in advanced Europe. So that includes the euro area, but here it would also include some Nordic economies and the UK. So tighter monetary policies. There was already a sharp tightening of monetary policy last year, in fact, starting last year in emerging economies, and that's now slowing, but it's still set to continue at a slower pace. On the fiscal front, given that the COVID-related support has been withdrawn, we're still in this economic outlook foreseeing a mild contraction of fiscal policy next year, meaning a mild fiscal consolidation next year. And you can see that from the blue dot for 2023 on the left chart, which shows you that there will be a fiscal consolidation in advanced economies. And you see that from the orange dot for 2023 in that same left chart for emerging European economies. Now, I really have to say here, though, that this chart is being overtaken by events, because the energy-related packages that are being negotiated and adopted by the day are changing this picture. And I think if we had to redo this picture right now, my best guess would be that, in fact, we'll see more or less neutral fiscal policy next year. That is neither a consolidation nor an expansion. So in light of this environment, we've downgraded our forecast for growth in Europe. You can see that in this table. I won't comment on it, but in a nutshell, we see Europe's growth falling from 2.6 to 0.6% next year. But I think more interesting is that for over half of Euro area countries, we are foreseeing a technical recession in the next 2 quarters, meaning 2 consecutive quarters of negative GDP growth. In several emerging economies, we're forecasting technical recessions as well, meaning 2 consecutive quarters of negative growth in Croatia, in Poland, Romania. And I want to stress also that if you compare our forecast for 2023 with the same forecast we had made prior to the war, Europe's GDP is projected to be about €500 billion lower next year than would have been the case, pre-war. And that, I think is a testimony to the large, in fact, economic cost from the war. The war is, of course, also having very large effects on the conflict countries themselves. This is obvious for Ukraine, whose GDP is forecast to shrink by 1/3 this year. But also even for Russia, vis-a-vis our pre-war forecast, we foresee Russia's GDP next year to be 10% lower than we would have foreseen prior to the war. And we are actually also forecasting 2 years of recession for Russia. Now, as you can see as well on this table, we're still foreseeing inflation to stay high next year in both advanced and emerging Europe. Over 6% in advanced Europe, over 11% in emerging Europe. So we're really seeing a toxic mix of sharply slowing growth and high and persistent inflation in Europe. And it's a toxic mix that could actually get worse. Why is that? It's because we see that risks are really unbalanced. If you think about the risk around our forecast, there's many things that could happen that could make things worse on both the growth front, but also the inflation front. For example, if you take those risks we listed on the right, several of them would be so-called stagflationary in nature. They could lower growth and raise inflation. An obvious one is a full Russian gas shutoff, but we could also see other ways through which the war would escalate that would likewise lower growth and raise inflation. Inflation could stay higher for longer on its own, something I'll come back to in a second. And if we think also of COVID-related risk, a new COVID outbreak would also typically be expected to give rise to a renewed bout of inflation and lower growth. Now, many of these risks are common to different regions around the world, but the one that's pretty Europe-specific is the risk of an aggravation of the energy crisis. That's illustrated here on the left, where we simulated a full Russian gas shutoff, okay, meaning a discontinuation of the 15% of Russian gas flows vis-a-vis pre-COVID levels that remain today. And so if those flows disappeared, what we are foreseeing is that we would need in Europe a demand compression, a gas demand compression of about 7% this this winter. And you see that from the blue bars on the left chart. But as you can also see, we would need a gas compression that would be a lot larger in landlocked Central Eastern European economies, the Czech Republic, Slovak Republic, and Hungary. So, these countries are much more vulnerable. And likewise, to a lesser extent, but large European economies such as Germany and Italy are also pretty vulnerable, and more vulnerable than, for example, a country like France. This situation has improved vis-a-vis last July, owing to, again, the storage that we've seen and that I've mentioned earlier on. But still, in a harsh winter, as shown in the green bars, in a harsh winter, the demand compression, the required demand compression could be substantial, and again would weigh particularly heavily on Central and Eastern European economies, and also to a good extent on Germany and Italy. But now, even leaving aside a risk of shortages and rationing aside, a renewed increase in gas and electricity prices would weaken Europe's outlook even more than what I've shown you in the table previously. You see on the right chart that a 50% increase in electricity and natural gas prices increases firms' costs by about 2% of GDP on average in Europe. That's the left chart. And it increases households' cost of living, so reduces households' purchasing power by about 1% of GDP on average across Europe, with wide variation across countries, reflecting the energy intensity, the energy mix, the extent to which they use gas in the energy mix in particular, and also the pass-through from higher energy prices to end users. But this would be quite a tax on European households and firms, would weaken the outlook. And now, a further concern is that even without an aggravation of the energy crisis, we could see inflation staying higher for longer. And one simple reason is that we don't fully explain the rise in inflation that we've seen. To a large extent, it's explained by rising energy and food prices. But as you can see from the left chart, there's an unexplained part to the rise in particular of core inflation that we've seen. And this unexplained part is about half of the inflation we're seeing today. This is based on estimates of conventional tools used by economists to model and predict inflation. And those tools, even factoring in what we know ex post, right, of energy and food prices, cannot fully explain the rise we've seen. And in particular, this residual, so this unexplained part, is well correlated, as you can see from the middle and right charts, is well correlated with some pandemic-related factors, in particular, the shares of firms that report labor shortages, shares of firms that report input shortages. So clearly, the pandemic has put pressure on inflation in ways that were new and unforeseen. And it's unclear whether these factors are going to very quickly wane or not. In our forecast, they're going to quickly wane, but they could stay higher for longer. And those risks, even leave aside two bigger risks that we think are low probability but high damage risk. And one would be a de-anchoring of inflation expectations. If firms and workers start expecting a different rate of inflation over the medium term and start pricing goods and negotiating wages on that basis. But there's a second related, conceptually different, but related risk, which would be a wage price spiral. That is, if workers stopped obtaining much larger, right? Not just larger, which would be fine, but much larger compensation for recent price increases, that could trigger a bout of wage and price increases that again would lead central banks to tighten more aggressively and would generate even more economic pain. So that's a further risk for Europe. Now, what does this mean for policies? On the monetary policy front, given these upside risks to inflation from a risk management perspective, especially given that monetary policy is still fairly accommodative in advanced Europe, there's a case, we think, for monetary policy accommodation to be removed, meaning for policy rates to keep increasing. And in all likelihood, we will need a tight monetary policy stance next year if we are to bring inflation down to targets over the medium term. In our forecast, inflation is going to stay above central bank targets in both advanced Europe and emerging Europe next year, even by the end of next year. So further policy rate increases are warranted in our view. That's exactly what's going on. And as you can see from the middle chart, if you compare it to the left chart, in emerging European economies, the tightening cycle started earlier. It started already last year, but that also reflects the fact that these are economies that have seen higher inflation, inflation expectations are slightly less well anchored, they've got much higher wage growth, and they came into the COVID crisis also, I think, with stronger cyclical positions, so stronger underlying inflation pressure. So they had to act also earlier than the ECB. On the fiscal front, there's an important tension, I think, right now in fiscal policy in Europe. On the one hand, there's a need for fiscal consolidation. There's a need for fiscal consolidation to rebuild fiscal space that was depleted because of COVID, right? And rightly so, by the way. Of course, we were right to stimulate economies during COVID, but now there's a need to rebuild fiscal space. Second, you want to consolidate to facilitate the job of monetary policy, that is, help monetary policy in the fight against inflation, because fiscal stimulus could be counterproductive and lead to tighter than warranted monetary policies and a weaker outlook. And third, you also want to consolidate because the cost of funding has increased. As I've mentioned, interest rates, long-term interest rates have risen. And on top of that, as you can see from the left chart, the government bond spreads between emerging economies and the core euro area have increased. So you want to consolidate. On the other hand, we are seeing an extraordinary energy crisis, and that energy crisis calls for helping vulnerable households and firms. And to do that, though, we need to be more efficient than we've been so far. The right chart shows you that a large share of countries, over 1/4 of countries, have used measures that suppress the pass-through from energy prices to end users, and that's bound to encourage consumption that can be very costly. So we need to be more efficient on this. The cost of protecting the bottom 40% of households from the higher energy prices we've seen in Europe, on average, about 1% of GDP. And the cost of packages has come closer to 2% of GDP. So clearly we can protect the vulnerable at a lower cost. And just two more slides, maybe let me finish on one on structural reforms, which is a long-standing issue and challenge for Europe. I would say there's long-standing reforms that remain priorities in Europe, in particular in labor and product markets, in improving labor force participation of women and older workers. But I think there's a new twist this time around. The new twist is that first, these reforms would help ease labor market pressures that I've mentioned, and thereby they would help ease inflationary pressures. So they really come at a premium, I think, today. And second, also the energy-related reforms, and in particular speeding up the green transition, also comes at a high premium now. Also because we need to improve energy security, we need to lower energy prices over the medium term, and that requires short-term responses such as using gas more efficiently, building storage, settling solidarity agreements that I've already touched upon. But it also requires more investment in the green transition, in gas connectivity, reducing fossil fuel consumption in industry and transport to, again, facilitate an energy transition, keep energy prices moderate over the medium term, and thereby ease also inflationary pressures. So to finish, we see a growing fallout from the war in Europe, technical recessions that are not yet deep recessions because the labor markets remain resilient. The economic indicators are not deteriorating across the board, but we're still going to face consecutive quarters of negative GDP growth. A very high uncertainty with a predominance of downside risk to growth and upside risk to inflation. So really a toxic mix because this is the most difficult mix for policy makers to handle. On the monetary policy front, we think the policy rate increases should continue at a faster pace in advanced economies because they started the normalization cycle of monetary policies later, and will need, in all likelihood, tight monetary policy stances next year in both advanced Europe and emerging Europe. On the fiscal front, consolidation should proceed while helping vulnerable households and firms weather the energy crisis, and that calls for more targeted, better design support, and that can be done. Some countries are doing it well, and I'm happy to elaborate. For example, Belgium, say. We'll need also a reform of the EU fiscal framework to provide the fiscal anchor that we no longer have, right? I think we're going to discuss that shortly. The escape clause has been activated, and so once it's reinstated, we will need a reformed fiscal framework in Europe to facilitate basically fiscal consolidation while helping macroeconomic stabilization. On financial policies, I didn't have time to discuss, but in fact, what we show is that households and firm balance sheets are going to come under stress because of tightening financial conditions and higher energy prices. Especially there's a fraction of households and firms that are vulnerable, And so risk of spillovers to bank balance sheet will need to be closely monitored. I mentioned the conclusion on structural reforms, emphasize energy, emphasize labor markets to ease inflationary pressures over the medium term. And finally, I think everything I mentioned would need to be reconsidered or at least adjusted, right? If some, downside risk materialize, and in particular, if the recession became a lot deeper than we're currently foreseeing in Europe. Thank you very much.
Thank you, Romain, for a very comprehensive overview of the toxic mix, as you called it. And I think Vice President Carol's used exactly those same words of the toxic mix that we're faced with. Before we start the discussion, could I just encourage the audience to put any questions you might have into the Q&A and the chat? I will try to regroup them. We will try to structure the debate around, firstly, the direct economic consequences. We will then later on move on to discuss a little bit about Europe's macroeconomic governance framework, and then finally we will debate individual policies. But before we do so, it's my pleasure to maybe have just a short round of first reactions from our three panelists, and I give the floor firstly to Charles Wiplosch. Very intrigued what you have to say as a reaction to this fascinating presentation. Charles, floor's yours.
Well, thank you very much, Lasse, and thanks to EPRS for having invited me. And I'm glad to be back at the European Parliament, at a distance though. And it was a great pleasure to listen to Romain's presentation of the usually good reports of the fund. Now, I have a lot of comments. I'll try to present some of them and keep them for the discussion. What I will say first is where I agree. I'm very happy to have heard Romain. Then I'll express some doubts, of course, otherwise it's not fun. And then I'll point out a few missing things that I think are missing. Now, I think the report, even more than Romain, goes at great lengths talking about the uncertainty. And I don't think any of us has lived in a period with so much uncertainty for many reasons, economics, financial, geopolitical, and so on and so forth. And we've seen that uncertainty with the constant revision of forecasts. Every time any forecaster speaks, we hear the forecasts have been changed, and they are changed in the wrong direction, namely more inflation, less growth. Things seem to be getting worse and worse. So there's nothing we can do about that, and of course it makes everything much more complicated. I just would like here to open a bracket and caution a little bit our listeners. The report and Romain talk a lot about the shock from the Russian invasion of Ukraine from a geopolitical perspective. It's been a massive surprise, I guess, to most of us. Now, in terms of economics, most of the bad things we've been seeing were underway before the Ukraine invasion, and they were building up and creating trouble. And there are a lot of things still happening. Just mentioned China in the background. That means we should be careful not to blame the war in Ukraine for the miseries we are going to. I think if people are told that the Ukraine war is the main cause of our miseries, then there might be a backlash on the support, and that would be politically detrimental. I don't think we should lie. I don't think we should hide, but I don't think it's good policy to say everything would be fine if only there would be no war in Ukraine. I don't think it's the case. I am very pleased with the IMF and Romain's support for the idea that monetary policy will have to be tightened further, especially in the euro area. As Romain said correctly, monetary policy is still accommodating, and inflation is still very high and not going down. So there is a little music going in the background saying, oh, maybe central banks have done enough. I think it's another dangerous music. Central banks have started to do what they have to do. They have started to move where they have to go, but they have a long way to go. And the IMF report is very clear on that, and I'm very pleased. The report also does the ritual thing of saying, well, fiscal policy will have to be, deficits will have to be stabilized and reversed and so on and so forth. We all agree with that. But while there are a number of quarters where there is pressure to cut down very quickly on deficits, the IMF says not so fast. And that's, I think it's courageous. And it's a very important message, especially in Europe, where there is always a rush. And there has been many instances when fiscal policies were reversed much too early and responsible for a lot of misery. Finally, I think another important message from the report that was maybe not as much emphasized by Romain at the end is that much of the fiscal support which we provide to firms and households should be much, much better targeting. We are wasting huge amounts of money to support people who don't need to be supported, and we don't put enough where there is a need for support, especially given the wage situation. So these are my agreements. Let me state a few doubts and started with the labor market. And as Romain said, we just don't know why wages are not rising faster. We just don't know where is inflation coming from, and part of the problem comes from our misunderstanding of the labor markets, what's happening. Now, in terms of there is this beautiful picture where we see a rising real wage trend, and we are falling badly behind. But this trend assumes there are productivity gains. And my reading of the recent 2 years is that there are no productivity gains because of the sad state of the labor market. So the trend doesn't exist for the time being. It's suspended, and it explains part of the problems. But at the same time, I mean, I've been very impressed by a recent paper by Blanchard, Domash, and Summers that explain why the labor markets are in difficult situation. This increased in vacancies with not much change in unemployment. We are going through a whole realignment of consumption and production, and we see a number of people who don't want to work what they were working before, and they are mildly looking for jobs because they just enjoyed a year of subsidized not working, and they'd like to continue it. So there is a lot of turmoil going into the labor market, and that means that this big vacancy and employment ratio are there, and they are unlikely to disappear anytime soon. So that's the fog of the labor market. Another place where I have doubts is the declining outlook is presented as very bad news. Now, first, we have declining growth following a record 2021 year, the bounce back from COVID. So that was never going to last. It had to come to an end, and we are living through that. So that part is fine. The second part is that monetary policy will tame inflation only if we have a sufficient slowdown. So it's not a bad news. It's part of the unfortunate solution of inflation, but we cannot at the same time be upset about inflation and be upset about the slowdown. We need the slowdown, and it's very important to remember, people, because the message is not clear. Finally, I was struck with the picture that Romain showed. I didn't see it the first time when I read the report on saving. So we had this record saving during the COVID lockdown when governments were sending subsidies to people. And there was a huge buildup of assets in the private sector, households and firms. And the data that Romain showed, they don't show this saving, they show saving going back to normal. So that means that consumers and firms are sitting on a pack of money much higher than before. And that's is calling for a lot of resilience in the economy, because households can go through not all, but can go through a tough patch, and firms as well, without there being a disaster. So it's important to keep it in mind. That may come as a surprise later, and it shouldn't. Now, if I have another minute, I'd like to say where I think I found missing, unless I didn't read carefully enough, but I think I did the IMF report. We need fiscal policy to keep supporting the people who are in need. And there are people who are badly hurt, and we know that this increases in energy and alimentation hurts seriously the poorer segment of society. So they need to be protected. And here there is the story of the fiscal space. Some countries have the resource, some governments have the resources to protect their people, not the others. And that has to be taken into account. And that's the time to start thinking a little bit of what we did with the recovery fund during the pandemic. There might be a need for collective action, because not all countries are in the same position. And we see all these discussions about the Germans' announcement about 200 billion. Clearly, a number of countries are officially upset, in practice jealous, but that has to be taken into account, because it's a true problem. And talking about that, I just mentioned in passing my hobby, debts. We have many countries now with debts much higher than 100%. This is not going to go away. What we're talking about is stabilizing the debts at these levels, but that's not going to be going away for the next 5 years, for the next 10 years. Now, over the last 10 years, I've been arguing we have to do something about the debts, and the response was always, oh, they're going to be brought down slowly over time. Then we had COVID, then we have Ukraine, then we have all these things. We cannot bet on a quiet next 20 years to continue living with this debt. And it's high time that there is discussion in Europe about debt restructuring. I know this is not allowed to talk about, so I'm sneaking here, and I say debt restructuring will have to happen. If we can do it quietly, it's nice. Otherwise it's going to happen in a crisis. Maybe I add just two things very quickly. As we saw from the figures that were shown by Romain, real wages have taken a beating. When inflation goes up by 10% and wages don't move much, the purchasing power of people is falling by 10%. There is no way this is going to happen. This is no way that is going to last. So either we accept that wages have to increase and we help a wage negotiation to protect wages, or we'll have major social unrest. Of course, as a French, I'm scared of social unrest, but it's starting, and not just in France, it's starting all over. So rather than waiting for large-scale strikes and people demonstrating in the streets, it would be smart for once that wages be raised. And that's a message partly to government, but mostly to firms. I know firms are waiting until the last minute, but this time the last minute is now, because the real wages have fallen by too much. Last word, I promise it's the last word. I think the report is a bit short in financial stability. We've seen what happened in England last month. Suddenly everybody discovered a new financial instrument that was wrecking the economy, which is exactly what happened in 2007. We discovered all this mortgage, subprime mortgage loan nobody knew about. There are tens and tens and tens of things like that we don't know about. They are hidden in the books of banks and especially non-banks. And when the interest rate go as far as they need, which is much farther than we currently anticipate, these cracks will happen. So I think there is a urgent need for the financial authorities to start digging under what they usually look at, not get out of their comfort zone and start finding out the next strange instruments that should have never been allowed. And I'm going to stop here. I'm sorry if I talk too much.
Well, you brought in some fascinating points. You basically took a big pot of salt and put it into some of the open wounds, the long-standing discussions that we're having, talking about debt, fiscal consolidations. Thank you for doing that. I'm not entirely sure whether you're an optimist or a pessimist, but maybe you will tell us once we come to the next round. First, I give the floor to Valentina. What's your view on the current situation? How will this weigh on, and what's the prospect for Europe's economy, businesses, and its people? Over to you.
So thank you very much for the invitation. It has been really very interesting to listen to these two speeches and also to read the report. So first of all, I also would like to take a little bit the perspective of enterprises and try to discuss what I found in the outlook and also again what in my view might be some challenges that go a little bit beyond what these forecasts have shown. I agree very much on the fact that we are facing, European businesses are facing a particularly challenging period, especially a period of discontinuity with the past. And this, of course, depends on the increase in energy prices and inflation, and also the consequence of a reversal in monetary policy. Added to this, and I saw this also in the outlook, is the decrease in world growth that has important repercussions for European enterprises in terms of the possibility to sell goods in international markets. And added to this, also the growing interest rates. So all these trends, they contribute to rising costs and to decreasing the demand. There are some, let's say, good or positive conditions, especially for firms in their capacity to serve debt that is stronger nowadays, also thanks to the policy response to the pandemic than it was after the global financial crisis. And then there are differences also across the sectors and across among, let's say, depending on the size of firms in the challenges that they are facing. Particularly, it's important to distinguish sectors where firms depend a lot on energy and sectors that were strongly hit by the pandemic. And it's also important to distinguish between large and small firms. So this is, let's say, the general framework, but my takeaway from the presentation is that considering the interplay of different factors that have been highlighted in the economic outlook, we are facing a period of change that is more fundamental than an energy shock. So in this, I very much agree with what Charles was saying, that the problem that European firms and economies are facing go a little bit beyond the invasion of Russia, of Ukraine by Russia. And they have to do with some, let's say, other trends that have to do with, let's say, global trade, the possible reconfiguration of global value chains, trends in technology, and also those shortages that were, let's say, highlighted before in terms of inputs and labor that are not only linked to, let's say, the expansion of employment after the pandemic, but are also linked to the kind of skills that are required for the green and the digital transition. So I think that already after the financial crisis, we experienced a slowdown in globalization, and the extent to which deglobalization will continue in the future is indeed uncertain, but there are many signals pointing to a different configuration of globalization with a possible division in trade blocks. And this may impact on the long-run perspectives of European economies. It's not only the Ukrainian war, but the Ukrainian war comes after the financial crisis, the pandemic shock, and all these shocks have shown the fragility of global value chains. And there has been a shift in the debate between efficiency and security in the direction of reshoring, nearshoring, and more recently even friendshoring. And at the same time, there is evidence that a concentration of production that would be the consequence of a reversal in globalization is detrimental for the resilience of supply chains. And therefore, this is where I see a long-term risk for future growth and inflation beyond the urgent necessity to solve the problem of gas shortages and increases in the price of energy. And I think that this is important also because it has something to do with the European fiscal stance and with the European, in general, European governance. Because if there is a fundamental change in the model in which countries trade goods and services, Europe might react by increasing investment, public and private investment, and this requires a more centralized fiscal capacity. Basically, it is very difficult to effectively undertake common industrial and macroeconomic policies favoring public and private investment that are necessary for the green transition and for ensuring the supply of strategic inputs and technologies without a progress in European economic governance. So I would like to leave this as a point of discussion also for a second round. Thank you very much.
Thank you, Valentina. And of course, we've picked the right date because the Commission tomorrow will present its communication on a future economic governance framework, and especially the future or a different future for the Stability and Growth Pact. Thank you also for your thoughts about supply chains and the future of Europe's economic model and what this means for businesses and the costs associated with it. And I put this question straight to Agathe. Do you agree with this? And what's your view? Are we drifting into sort of a deglobalized world, or a world that is falling apart into different blocks? And what's your takeaway on what Europe should and must do? Agathe, floor is yours.
Thank you very much, Lasse, and thank you very much for organizing such a great event. So thank you, EPRS, thank you, Vice President Caras, also Etienne Basso, Lasse, Marie-Cécile, who helped us with the logistics, and the other panelists. So I think that's something that we've heard a lot during the presentation and during the talks that we've just heard is the word crisis. And I thought it would be good to define what crisis we're talking about, because it's really three, at least, different crises that are happening at the same time. The first one is an economic and social crisis. The second one is an energy crisis. And the third one is a geopolitical crisis. So I thought I would share some thoughts about these three crises from a very global perspective. I used to cover Europe for the EAU, and now I'm the Global Forecasting Director. So my world is a bit broader than Europe. It's also about the US, China, emerging countries. So the first crisis that I wanted to talk about is the economic and social crisis. And I think that here it's very clear, listening to the presentation from the IMF, that the year 2023 will be crunch time for Europe growth, but also for global growth. And at the EAU, we expect global growth of only 1.6% next year, compared to 2.8% this year. And crunch time will be in the first half of 2023. If we take a look at the three economic powerhouses, the global, the major economies globally, so the Eurozone, we believe will register a full year recession next year, minus 0.4% recession, with full year recessions in Germany, in France, and Italy. That's our forecasts. The US, we believe, will enter a technical recession in Q4 2022, Q1 2023. That is to say, 2 consecutive quarters of economic contraction on a quarterly basis. And we believe that US GDP will essentially stagnate next year, 0.2% growth. And finally, China. Well, China, we believe, will register only 3.3% growth this year, which is essentially a recession by Chinese standards, and only a modest rebound of 4.7% next year. So that's really a bleak picture at the global level. And I think what's interesting here is that the causes of this global slowdown are different when we take a look at Europe, at the US, and at China. So the Eurozone, obviously, we've discussed very extensively, so I won't say more. That's a bleak outlook ahead. I would just emphasize the fact that there is also a social crisis. We've had a discussion about real wages falling, so there is a lot of social pain. The US, well, the US is more insulated from the consequences of the war in Ukraine than Europe. And this reflects the fact, at least in part, that the US is a major energy producer. So the situation is a bit different for the US. And the main cause of the economic slowdown in the US is aggressive monetary tightening from the Fed. That was on the first slide from the IMF presentation, because the Fed is prioritizing the fight against inflation. It's happy to have low growth, stagnation, economic stagnation, but it wants to fight against record high inflation. And it's not over. We actually forecast 2 more rate hikes from the Fed, a 50 basis point rate hike in December and a 25 basis point rate hike in February next year. And finally, I was mentioning China. So China is facing a difficult set of challenging conditions. Some of them are domestic. Zero COVID, we expect, is going to last in 2023, no end in sight, but also a recent drought, some problems in the real estate sector, some problems in the power sector, and obviously also the global economic slowdown, which is weighing on China's growth, and geopolitical tensions. I will discuss this in the geopolitical crisis part of my talk. And so a slowdown in one of these economies means a slowdown in the others. So obviously everything is linked, and it will have ripple effects in emerging economies also. There's only one notable exception, it's commodities producers. So that's the economic and social crisis. Big takeaway here, 2023 will really be crunch time. The second crisis that I wanted to mention is the energy crisis, and it's obviously making matters worse for Europe. And I think here the takeaway is that the era of cheap Russian gas for Europe, and for instance, Germany especially, is really over. I think there is a common misconception, and I know we'll go back to that in the discussion part, that this is due to sanctions. It is not the case. Energy prices were already high on February 24th. It might actually have played a role in Vladimir Putin's calculus. And there are no sanctions at the moment in Europe on Russian oil imports, and it's Russia that has turned off the gas tap. So it's not due to sanctions, the energy crisis. But actually, we're talking about the energy crisis, but it's not only about energy. It's about Russia weaponizing commodities supplies, because the only thing that Russia knows how to do for the Russian economy is to produce commodities. We're talking about energy, but also grains, gold, fertilizers, metals, etc., etc. And so the Russian strategy is really to fuel divisions in Europe with this weaponization of commodities supplies. And we can see actually the debate in Europe about sanctions playing a role in the crisis. That's exactly Russia's strategy. So we have tough times ahead for Europe, a very tough winter ahead. Actually, next winter might be even worse because, as we've discussed, Europe has managed to refill gas storage this time around, but it may not be the case next year. And also, the weather at the moment is pretty mild across Europe. It may not be the case next year. So that's really a key risk. We don't really look at weather forecasts usually to do our economic forecast, but this time we need to look at weather forecasts. And so adaptation will take some time in Europe to adjust to this energy crisis. What it means is high input costs for some European industry. Metallurgy, for instance, is in a bad place. The automotive sector is also in a bad place. Chemicals, well, everything where you need a lot of energy. And that may lead to some relocation of some European industries elsewhere, possibly to the US, which is obviously a bit of a tense point between Europe and the US at the moment. But in the medium term, we could wonder if this energy crisis could be beneficial for Europe because it will accelerate the push towards renewables, towards building an LNG infrastructure, and towards boosting gas imports from other sources, such as Norway, for instance. So we could see it as investment for the future, even though there will be a lot of economic pain in the short to medium term. And finally, the geopolitical crisis, I will end on this one. Well, that's the third crisis that I wanted to mention. And the war in Ukraine is an illustration of it rather than the cause of it. It's a fragmentation of the economic, financial, and geopolitical landscape that we're seeing at the moment. We can, of course, go back to that question, and I'm putting here my hat as a former French Treasury official in Moscow and in Lebanon to discuss this. What we're seeing, and this hasn't started with the war in Ukraine, it predates the war in Ukraine, is that Russia and China especially are challenging the Western-led global order that had emerged after the Second World War. And actually, when we take a look at the national security strategy that the US has put together, I think it was published last week, it's very interesting because Russia is seen as an immediate but declining threat, whereas China is seen as not an immediate threat, but a rising one. So I think that this will be a very interesting question and a very big challenge to tackle for policymakers. And what's interesting too is that emerging markets will be the prize for both Western countries and for Russia and China, because emerging markets are up for grabs, for influence there, for what I would call market share for influence. And so we're going to see a lot of battles. We've seen it with vaccine diplomacy, for instance, with Russia and China sending jabs to emerging countries. And we're going to see it with grains diplomacy, because Russia is weaponizing grains exports to pretend that sanctions are the cause of food insecurity. That's not the case, but still, it's a narrative that is gaining traction in emerging countries. And so I wanted to end on two consequences of this situation, among many others. The first consequence, and Valentina has discussed this, is the regionalization of supply chains. It's not new. It had started with COVID, with the realization that if we depend on supply chains that are located very far away for some critical goods like masks, maybe it's not a good idea. And so the question here for Europe will obviously be what role for Europe in global supply chains? Does Europe have a strategy here? That's a very interesting question. And the second takeaway that I wanted to finish on is that we're going to see a lot more economic and financial fragmentation. with a rise in non-Western financial channels. This is something that is discussed a lot. That's de-dollarization, for instance. That's also alternatives to SWIFT. China has built one. It's called CIPS. And also digital currencies, which are currencies that are issued by central banks. 300 million Chinese people use a digital currency at the moment, over which Western countries have no oversight. And this is actually a threat to the long-term effectiveness of sanctions. This is something that I discuss in my book, Backfire, about the global ripple effects of US sanctions. It will be out next week. And to me, it's a threat to the long-term effectiveness of sanctions and to Western diplomacies, because if Western countries do not have sanctions as a diplomatic tool, they will be left with only two other options: diplomatic condemnations, that's not going to impress Vladimir Putin, or military intervention, which is obviously very deadly and has a high human and social cost. Thank you very much. I'll end here.
Thank you for giving us this crucial context. While we enter into the discussion, can I kick off with a question going back to Romain? With the big question, we'll come back to the most feared word of 2022, which is called the word inflation. We have a question in the chat, Romain. What is the relative weight of aggregate factors in the current price spike? Firstly, war-related supply disruption. Secondly, supply disruption and postponed demand during the pandemic. And thirdly, delayed effects of the expansionary monetary policy. So the question is, what caused inflation? And can you sort of give your views on which of the three factors played a bigger role? And maybe at what time? I think it was hinted at, for example, at what Charles, but also Agathe said.
Thanks, Stas, and thanks to the panelists for great interventions. This is really the toughest question you can ask me, I think. But so let me give you what I think we know and do not know. So there's ways economists can try and disentangle these effects, and we, like many others, have tried to do that. So you try and, in particular, disentangle the supply effects from the demand effect, right? There was the demand effect coming from, in particular, the strong recovery from the pandemic, some of which was spontaneous, right? The consumption binge, once economies reopen, and some of it was just fiscal stimulus, right? So you've got this demand side, and the supply side is, for the most part, so the effect of COVID and the lockdowns themselves, and then once the war started, right, the effect of the supply shocks from the war, and for example, Agathe reminded us that in fact the gas crisis is essentially a supply shock because it is Russia that decided to turn off the tap. So we did such an exercise before the war, and had concluded that in Europe it was about sort of 50-50, 50 demand, 50% demand, 50% supply. Take that with a grain of salt. These are based on econometric exercise, statistical exercise. I'm not going to elaborate upon, but that have their weaknesses. I think the consensus is that at least in Europe, it's been less demand and more supply than has been the case in the US. I think we can sort of fairly say, because there's been a lot more fiscal stimulus in the US to start with, a stronger private demand recovery in the US. You see that in the data. And the US has been less affected subsequently by the supply shock, right, from the war. So there's more of that, in a way, demand story in the US, which is also why you see more monetary policy tightening in the US, and market expecting, monetary policy rates to eventually go higher, right, than they are currently expecting for Europe. But I'll stop there because, frankly, this is an extraordinarily difficult question. Thank you.
Well, maybe we move on from a difficult question to another difficult question, namely one which was posed to us by Charles with his passionate plea, if I may say, on wages needing to go up. Do you see a wage price spiral becoming entrenched? And what's your view in reaction to Charles's proposal or demand that wages should go up? What's your view on this?
Yeah, thanks. I actually wanted to say a word on that, so it's great that you're asking me. Yeah, absolutely, right? So you want wages to go up, they will go up, and they have to go up, right? I think the question is how much higher should they go, right? What's sort of a reasonable pickup versus a sort of a worrisome pickup, right? At the end of the day, it cannot be that real wages will fall as much as they've fallen so far. I'm totally with Charles on this. So that's sort of the lower bound. We cannot stay that low. On the other hand, there cannot be a full compensation, right, for the price increases that we've seen, simply because this is a supply shock that Europe is facing, right? Gas has been lost, and European households and firms, Europe as a whole, has lost permanently income as a result of this crisis, right? At least until it's able to fully ramp up, renewable in a more distant future, when we come back to slightly, more reasonable energy prices. But we think energy prices are going to stay higher for longer, and for many years. So, right? You want higher wages, but not full compensation for price increases. So what would be reasonable? I think something like trend productivity growth plus GDP deflator growth is something that would preserve the labor share of income, right? It would stabilize the labor share of income in Europe. So that's kind of a reasonable benchmark, right? With trend productivity growth, let's say 1%, GDP deflator growth or something like 4, it would mean sort of wages around 4 or 5, would be a reasonable benchmark right now. Again, with wide variation across countries, right? Different countries have different inflation rate, productivity growth rate. So I don't want to enter into details, but I wanted to mention that. Now, as regards wage price spiral risk, we look into those in this publication, and what's really clear, what comes out when you look historically at how price shocks propagate to wages, what comes out is that when you already see high inflation, the propagation is much faster and stronger. That is, if you start from a position of high inflation, wages and prices adjust much more rapidly to new shocks, such as an oil price shock or a gas price shock. So these risks are clearly higher than they were in the past, simply for that reason, right? And in that regard, we argue that this is a further argument for why central banks, should tighten monetary policies to precisely keep those risks at bay. Right? Thank you.
Thank you. I wonder, maybe Valentina or Agathe or maybe Charles, you would like to come in on the question of wages, because of course there is the question how far increased wages weigh on the competitiveness of Europe's businesses and the economy. So by all means, do come in if you wish on this. I see Charles would like to come in with a question. Yeah.
Yeah, I'd like to answer Romain about the how far back the wages will have to go up. So we have wages divided by prices, and they have gone down. Now, one reason is that we have this transfer on the increased prices of imported stuff, energy, minerals, and so on and so forth. So somehow we have to pay for it. And one way of this happening is it's included in the prices, and we don't increase wages, and this way we pay for the transfer. That's part of the story. According to the data that Romain showed us, it's a significant part, but it's far from the whole part. And it raises complicated questions of income redistribution that I just want to signal I don't want to get into. The rest, what happened to the rest? Well, I flip around. I say price of our wages have gone up. So some firms are doing very well, not all of them. And again, there is a question of distribution. But some firms are having a great time, and because they are at the right place at the right moment. So it's part of business. Sometimes you are at the right place and you benefit, sometimes you lose it. But the numbers we have now are truly historical. And that's what I mentioned before. It's about time that the firms that did well pay back at least part of what they have in wages, and maybe to support the other one. So we need a combination of fiscal policy to do the income redistribution. It's a political issue. It's not for me to talk about, but it has to happen. At the same time, firms have to give back some of the big profits that they have gotten.
Can I pick up the word fiscal support, since you spoke about it, but because all of you brought it up in various shapes and sizes. The IMF report, just to recap, obviously says that interest rates need to rise, and on the other hand, we need to consolidate debt. So my question to the panel at large is how worried are you about high debt? This was a particular point by Charles, and I know you've done a lot of academic research into that question. So how worried are you really? And secondly, how targeted can and should fiscal support be, and what the role is for the EU? So ultimately, it goes back to the question I asked Charles: Are you an optimist or a pessimist? So how likely is it that we will come to either an enlarged next generation EU model or type fund, or some different scenario? But I put the question to the entire panel, really. Is there? I see Agathe has a hand raised. Maybe ladies first, Charles, before I give the question to you.
Yes, I'm happy to go first with some very brief thoughts. So actually, we had done a paper about this very question at the start of the COVID pandemic, warning that some debt crisis might be coming because of the huge debt pileups. And so obviously the situation is tricky, but we are not too worried about the debt pileups in Europe. We think that things are going to be sustainable. That being said, I think that what happened in the UK, and we've mentioned it a few weeks ago, and I'm based in London, so I certainly had a close look at it. I think that it was a bit of a signal for some European economies that still high debt pileups will need to be tackled, and that financial markets will ask for some realistic plans on how to reduce the debt burden and fiscal deficits, because I think that there was really this crisis of confidence, and financial markets really showed, at least in the UK, that there was, well, the situation was uncertain, and the UK government really needed to have a credible plan as to how it would reduce the fiscal deficit and debt. What we're worried about, however, I said Europe, we're not worried about, is emerging markets, and especially emerging markets that are highly indebted in US dollar because of the strong dollar. And I see that we have a question on this one. So that is going to be a very tricky situation to manage for many emerging countries amid high inflation, the debt pileup that needs to be managed, very low fiscal space to do some fiscal consolidation. So we could have some social unrest in some emerging economies. We've seen actually it happening already in Sri Lanka, for instance. And so a number of emerging economies are really at high risk of debt defaults in the coming year.
Thank you. So Agathe is an optimist. Charles, you still haven't answered my question whether you're an optimist on debt and fiscal capacity at the EU level.
I'm neither an optimist nor a pessimist, or I oscillate all the time, but I'm scared. I'm scared because the situation is truly historical. The difficulties we face, we've not faced for ages, and we see beautiful political speeches, but I think there is too much scare among politicians to really take bold initiatives. Although the ECB has made a progress, the recovery fund or next generation has been a total surprise to me, and it happened. It's not perfect, but it happened, and right now I don't see a continuation of that. On the debt pile-up, what Agathe correctly calls a debt pile-up, I agree. There is no crisis in the immediate horizon, although when interest rates start rising a lot, we can revise this view. My concern is that it will take a lot of time to bring debts to possible levels, I mean, comfortable levels. And during that time, shocks can happen, and then we can have a crisis. So we put ourselves, or we are in a very vulnerable position with these large debts. On top of that, European countries and Western countries in general will have to spend a pack of money on climate change because they don't want to have a carbon tax, and on defense spending. We've changed. The world has changed, and defense spending is going to go up. Where is the money going to come from? Without this spending, these additional spending items, we have never been able to really cut budget deficits in most countries. That's why I'm scared. I don't see any addition that makes any sense at this stage. And therefore, the idea that there is no debt crisis on the horizon seems to me a bit too optimistic.
Thank you for being so honest in your response, but certainly very profound in your thoughts. Now, I feel like I am a bit of a party pooper because looking at the watch, it's already 3 p.m. and I believe I feel like the discussion is only about to start because it's becoming really interesting. But we will have to wrap up for the simple reason that people here in Parliament have committee and other meetings, which is why we schedule this discussion at this hour. Can I make a pragmatic proposal? If I give each one of you the floor for 1 to 2 minutes, because I see Romain and Degat have their hand raised, and I'm sure Valentina would like to come in on some of the points. So 1 to 2 minutes each. Final round. We go maybe Valentina first, then Agathe, and then Romain last, so in reverse order. And there is a remaining question in the chat on Russian commodity exports, technology exports to Russia and how far they impact Russia's commodity exports capacity. And I see Agatha nodding. Maybe you would like to say something on this question. So final round, Valentina first, then Agatha, then Romain.
Yeah, just a few words about this tension between, let's say, fiscal consolidation on the one hand and the challenges that Europe is facing. I think, of course, this is a difficult tension, but there are two paths that we can try to follow in order to reduce this tension. The first one is selectivity. So basically, there is not necessarily a trade-off between the reduction of overall spending and targeting some priorities. Something that has not happened so easily, especially in my country, so in Italy, in the last years, where we have penalized a lot of investment, continuing to increase public less productive expenditure. And the second one is the balance between national and European spending. This is for at least 2 reasons. The first one is about the cost that is going to be lower when we have a higher level of central fiscal capacity. And the second, more fundamental, is that a lot of areas in which we need to increase investment are areas of common European goods. That is area in which there are very important spillovers from one country to the other. This is the case of energy, environment, public defense, health, and therefore just duplicating national investment does not make much sense. That's why I think that, again, a change in the balance between the national and the European spending and changing in the balance between investment and other type of spending would somehow make the trade-off between fiscal consolidation and economic growth less severe.
Thank you for putting it so succinctly. Agathe.
Very briefly, so there are 2 things that I wanted to mention actually in response first to Charles' point on financing climate change. It's also going to be in the long term about financing the aging of the population because that means increased pensions and it means also increased healthcare costs. So that's going to be a long-term challenge for many European countries. The second thing that I wanted to do is take on the question about export controls to Russia. So I think that to answer the question, I think it's good to go back to the objectives of European sanctions and Western sanctions in general on Russia. The first objective is to send a diplomatic signal of resolve to Russia, and I don't think that Russia was expecting such tough sanctions to be imposed in such a unified manner. The second objective is to constrain Russia's capacity to wage war. So this can be done by provoking a recession in Russia, which is happening at the moment, or also constraining Russia's technological capabilities, and I'll go back to that in a second. And the third objective is also to constrain the long-term outlook of the Russian economy. And so if we go back to the export controls question, there are two sets of export controls that do different things against Russia. The set that is going to have an impact on the short term targets the export of semiconductor technology to Russia. And this is actually going to be a really critical issue for Russia because all the missiles that Russia is using in Ukraine, the Iskander and Caliber missiles, are full of US microchip technology. And so Russia is depleting the reserves of missiles, but it's going to have a problem to replenish these reserves. So this will have an impact on the war. And the second set of export controls that I wanted to mention are going to constrain the outlook of Russia's energy sector because a number of Russian energy fields at the moment are seeing their reserves depleting very fast. Russia needs to develop new oil and gas fields, but to do so, it needs some financing, and Western financing is not going to happen. It needs some technology because many of these fields are located in the Arctic. And so far, only Western countries have that technology. So in the long term, Russia is going to face a very difficult situation. The energy sector is going to have very bleak prospects, and this is going to add to a bleak outlook in general for the Russian economy, even if there were no sanctions because of a declining population and very low productivity growth. And so to go to the question, which is exactly about, does the EU have any realistic solution for Russia's commodity supply prospects because of export controls? We are going to look at a reshuffling of global supply chains because of the war in Ukraine, because the combined impact of companies not willing to do business with Russia plus sanctions means that a number of Western economies are turning away from Russian commodities. So we mentioned energy, gold, fertilizers, metals, etc., and they're going to turn away from Russia. So we're probably going to be looking at European countries having other suppliers than Russia, and so long-term reshuffling of global supply chains. I think it was more than 1 minute, sorry.
Thank you, Romain.
Thanks, Nas. Let me try to make one point on fiscal policies in 1 minute. So one is, I think we really have to differentiate across countries, right? When it comes to fiscal risk, we have to differentiate across countries depending on their debt sustainability prospects. I know the proposal that we at the fund put forward to reform the EU fiscal framework tries to do just that, right? Classify countries into high risk, medium risk, and low risk on the basis of their debt sustainability and an analysis of it. And that would form a cornerstone for reform, Stability and Growth Pact. So, of course, we'll see tomorrow what the European Commission is going to propose. Second is on fiscal. What's the role of the EU? You asked, right? In energy support. So I would say that these two things. So one is, the joint gas purchases can make sense, right? But you also need some more coordination on the national support given to national firms and households, and particularly firms, right? This is a European level issue. Energy security is a European level issue, and it's best addressed at the European level, with an eye on the single market, right, and preserving the single market. And very finally, in the future, I think also Valentina mentioned this. There's a large investment needs in Europe in the green transition, very large ones, and we're facing severe fiscal pressures. One. Second, we will also be facing crisis in which an EU-wide fiscal response will be helpful. And so to meet those two objectives, what we propose is that there be essential fiscal capacity in Europe, and the EU was a really good start in that regard. And there, could be a central fiscal capacity that could take care of both, basically, right? Both investing in energy security and climate change mitigation while providing in bad times a potential, stabilizing device, right? That would basically stabilize the economy, including by issuing common debt. Thank you.
I think it's not the last time that we have discussed this issue, and we might see each other again on another panel. It's with a heavy heart that I have to pass on the floor to Etienne. I would have loved to continue this discussion. It's already 3:09. Etienne, unfortunately, the microphone is yours.
Thank you, Lasse. Thank you to all speakers, in particular to you, Romain, for the very exciting presentation and discussion in the follow-up. I was just thinking, when Lasse, you were asking about if we're optimists or not, I was thinking about Jean Monnet, and he said that he's not an optimist, but he's determined. And I'm saying this, why? Because I think that the EU is not unequipped to answer to this. I mean, we have shown that we are capable to reinvent ourselves with NGEU, with the common purchase of vaccines and things like that. And there are further possibilities that could be activated, like a central fiscal capacity. And I'd like to refer to the EPRS Future Shocks report, where we also identify possible solutions that can be taken on by the politicians. So this would be my conclusion. And I'd like to mention also a couple of upcoming events that are actually linked to our discussion today. We'll have tomorrow a book talk on Sven Biskop book, Grand Strategy in 10 Words, A Guide to Great Power Politics in the 21st Century, very much linked to what we discussed today, and two events that are linked to monetary policy. One event next week on Tuesday, 15th of November, looking back to history, the Delors report revisited how the euro was born, and we'll have the privilege to have with us Jacques de la Rosière, Ivo Maas, Neil Stigerson, Michel Chang, and yourself. I think Lasse will be participating to that event. And later in the year, on Tuesday, 29th of November, we'll have another event on monetary policy, fiscal and monetary policy, two sides of the same coin. Also a very interesting event. The second I mentioned will be an event in presence in our library reading room, but also broadcasted for those who want to follow online. So again, many thanks to all of you. Have a great day and see you soon. Bye-bye.
Bye.